Hello everyone and welcome to today's webinar. This is Dan Cooper and I'm going to be joined by Peter Wyant and Greg Storm, also of Reinhart. And thank you so much for tuning in today for the webinar entitled Protect and Grow Your Privately Held Company's Value, 12 Timely Ideas and Strategies. At the outset here as a summary, the ideas that I'm going to be talking about or that we're going to be talking about today are really outgrowths of a business law blog that I keep online. And really the idea behind this is focusing on protecting and growing value. When it comes to legal advice, my view is that it is most valuable when it's really tailored with the business goals and the personal goals of the individuals running a business. And the legal advice should always have a singular philosophy, and that is add the maximum value and protect company value. So it's really about the business, not legal advice in a vacuum that is academically correct but not relevant. So with that as a goal, what I'm going to be doing is talking about 12 different topics, and so we're going to be jumping around quite a bit from wide-ranging topics. Not everything may be relevant to everyone, but hopefully everyone finds something relevant. And there'll also be, it'll be more of an overview, but different levels of depth that we get into within the different topics in order to present a view into what's going on out there in business and how legal advice can help companies protect and grow their value. So with that as a brief introduction, and this is going to be a 1-hour webinar, and in being respectful of everyone's time, we'll keep it exactly to an hour. There'll be a little bit of time for question and answers at the end. But I'm going to be keeping a pretty brisk pace because we have 12 topics to get through, and obviously that's going to mean a fairly brisk pace going through each topic. Jumping right in, the first two topics actually are on a related feature, and they're going to be relevant to common structures for capital raise transactions. In the current economic environment, there is a lot of activity going on right now with early stage and second stage growth-oriented companies that are seeking investment capital from investors, and investors are searching for those golden opportunities to provide investment capital for a growth-oriented business in exchange for an equity position. And I'm going to be having slides to keep up with the webinar as well. So sorry for being a little bit behind there, but now you should have a slide that matches the topic that's being discussed. So I'm going to go over a couple of common structures that I'm seeing out there for common capital raise transactions. And the three that I want to talk about are really just plain common stock investments, convertible preferred stock investments, and participating preferred stock investments. Common stock or units is kind of the simplest and fairly intuitive, and usually this is the case when you have very early seed funding type investors coming into a company that may even have a friendly relationship, a friends or family type relationship with a business entrepreneur. They may come in with just common stock sharing with the founders of the company, and the thought is that since it's so early on, they're really part of the founding group, and it's really hard to determine what the value of this company will be, and so they may be willing to put in cash and just share on a per unit basis, share for share, with the founders. One of the benefits and attractive features of this approach is it's very simple. Everybody just kind of in, share, and like, and it keeps the administrative expenses of the company low as well. And then if there's a growth within the company and then a subsequent round comes in, typically that will be one of the other types of equity investments, convertible preferred or participating preferred stock within the entity. Just a quick summary of convertible preferred and participating preferred. There is a little bit of confusion sometimes on the labels, and it's not always a uniform lexicon that applies to investors and companies when they're looking at these types of investments. But what I mean with convertible preferred and participating preferred, convertible preferred would allow an investor to receive preferred stock, which means that before funds are issued in dividends or liquidation funds in the event of a future sale, the preferred holders would have the option to receive their investment back first, usually with preferred dividends. And if the company does well and gains a value that's far in excess of what the preferred shareholder invested, then they have the option of converting into essentially common stock and participating on a proportionate basis as if they were common shareholders. So this would be the distinction that I like to use between convertible preferred and what I call participating preferred are either or and both and. So in the convertible preferred, the preferred investor chooses between the preference of receiving their equity back or converting in to common and receiving common back. With participating preferred, it's both and. The preferred investor would receive their initial investment back with the preferred dividends, and then would also participate in a percentage on an as-if converted basis with common, or an actually converted basis with the common stock, on the rest of the proceeds. When I talk with entrepreneurs or early-stage business owners, sometimes the tendency is for them to want to steer toward convertible preferred rather than participating preferred, thinking that it's kind of easier to get your arms around, and if the company does very well, it makes sense for the investors just to prepare on an as-if converted basis. However, what I see in practice is that participating preferred is probably the more common structure. Investors like the safety and security of knowing that their their investment will come back first, but also obviously want to participate in the upside to reflect the significant risk they have in the company. And typically, companies, it depends on the economics and the personalities involved in every situation, but oftentimes it doesn't actually make that big a difference, because in the long run, if the company generates substantial value, if you track it out on a percentage basis, the difference between convertible preferred and participating preferred is going to be not that radically different when it comes to return on investment for the preferred investors. And the founders often will want to try to minimize to the extent they can the amount of dilution that they're going to experience in the investment. And oftentimes structuring an investment as participating preferred, it allows the preferred investors to come in with a little bit less focus on dilution of the stock they'll get, because they know that they have that built-in protection and the upside going forward as well. Turning to the next topic, which is related to the first topic, a wrinkle that comes up sometimes is what if a company is fairly early stage and it's always difficult to determine what the value of the company is going to be, but what if it's particularly difficult because the founders believe that the value is much higher than the investors' the company's value is, and it's just a sticking point, and the parties are having trouble moving beyond that. A couple of tools that exist to try to allow founders and investors to move past this issue, and it gets a little bit more tricky and complicated, but is to have some kind of reduction in issued units if a special designated return is achieved by the investors. And then another tool is to issue bonus shares or units to founders for achieving performance goals. And the idea behind this is that if the founders believe the value of the company is much higher than the investors do, and then it turns out that the company does perform very well very quickly, and the company is able to return on a preferred basis the investors' capital back to them with preferred dividends or interest, then it may make sense for the company to automatically adjust the amount of equity that was issued to the investors to essentially reduce the amount of equity going forward held by the investors to accommodate the fact that they essentially have less risk going forward. They've already received their money back, and it turns out that if we go back to the time of the investment, the underlying value of the company really was probably greater than the investors were fearing that it may be. So it's sometimes a way to bridge a gap when there is a valuation gap between the parties. And a related tool would be issuing bonus shares or units to founders who are achieving performance goals. If the founders are expected to achieve business goals and they are able to do so, on a demonstrable basis after the investment, they could be rewarded by getting extra equity, which essentially might reduce their initial dilution from the investment. Now, there are tax issues between these approaches that can come into play, and there are special tools that can be used to try to optimize the tax result to everybody. But that's oftentimes a tool to allow the parties to move forward when there is a valuation discrepancy. Since time is moving quickly, and we have many topics to cover, I'm going to move into the third topic for today, and that is primary goals for company succession planning. I've been seeing quite a few companies that have family-held origins find that the optimal exit for or transition for the family is for junior generations to grow into the leadership roles of the company, and for the company to need and the family to need legal structures and support to help facilitate that transaction. And it is obviously an important time for the family and the company when there is a succession plan that's in place. A couple of main factors, and some of these are beyond legal factors, but business continuity and growth is going to be critical in the process. Also, family fairness. There may be active and inactive members of second or third generation that are going to be gated by the company's succession plan, and it's going to be critical in all situations for the family to have something in place that is going to be fair and essentially incentivizing for all members of the family as they adjust circumstances. Cash flow planning for retirement is a critical factor for the generation that is transferring equity to the next generation. Making sure that there is a plan for cash flow to in most cases fund their living expenses, or perhaps that's not as necessary because there's more reserve built up. But whatever the situation, making sure that the tools are in place, the legal tools are in place to accommodate the goals. And the key there is not to have anybody from the transferring generation kind of painted into a corner later on where there was insufficient cash flow plan. And then other items are tax planning. And Peter Wyant of the firm is going to be talking a little bit about some legal structures that help us maximize tax planning and simplicity. Simplicity is an overriding goal. There are lots of legal tools that are available to help with a company succession plan, but keeping sight of not losing the forest for the sight of the trees in a way is important in making sure that the documents are achieving the family's goals. So with that, Peter, would you be able to comment on some of the common legal structures in succession planning situations?
I would be happy to. Thank you for having me today. The first one, the most, touching on simplicity, the most basic and the one I would recommend in all situations is just the proper basic estate planning in place so that when the senior generation passes away, whether they're planning to pass the business at death or if it's an unexpected event earlier on, that the business passes the way the business owners want it to pass, and that you're not relying on the laws of whatever state you happen to be a resident of to pass that business on. So that'd be for planning for the business succession upon death. Then there's some other structures that we sometimes will do during lifetime, and this kind of, with the simplicity and cash flow balance, you don't always get both, but you can do just gifts of business interests outright during life. That's pretty straightforward. Then you can also do gifts into of the business entity into a trust, an irrevocable trust for the benefit of the next generation. That adds some complexity, but that also allows the senior generation to provide some control. The downside of those two structures is that there's not a cash flow flowing back to the senior generation, which might be a concern as they move forward. So then moving on, so you're starting to get a little bit more complex now, but these are also fairly straightforward situations to structure. Is you can just sell the stock to the next generation. You can also sell the stock to a trust for the next generation, or you could have the company redeem that stock and actually purchase it back, which provides a cash flow to the senior generation, which can be quite important in the planning situation. And then also there are some corporate structures that you want to discuss and get in place, and one is splitting the actual voting from non-voting stock. And that allows the senior generation to start to shift that value to the next generation but retain control if they want to do so throughout their life. And then also, we oftentimes, and Dan, I think you'll be able to speak on this too, is put a buy-sell structure in place so that when we are transferring these units, you can retain some sort of family control over the situation. And I don't know if you have any comments you'd want to make at that time about that.
Yes, that is an excellent point, and buy-sell agreement is a very useful tool in accomplishing these goals and really getting back to protecting company value with respect to continuity planning. You may have a situation where one or a group of members of a new generation that are siblings is active with the company and stepping into new leadership roles, and then another group may be inactive. In fact, maybe they live elsewhere, and there may be very different goals within the family. Oftentimes having a structure in place where the company over time can provide funding to fund a buyout where the active members or trusts for the active members are going to buy out equity from their siblings that are inactive helps to, in the long term, helps provide funding that may be consistent with the goals of the inactive members for diversifying their investments, essentially, from their inheritance. And for the active members, aligns the interest that they may feel in growing value of the company for their family's benefit going forward.
Also to touch briefly on, you have insurance on your slide. We will often create an irrevocable life insurance trust, which is an irrevocable trust properly structured so that the insurance premiums can provide liquidity for state tax payments, but they do flow outside of the taxable estate. Having mentioned that, I'd also like to just briefly mention that every individual as of this year can pass $5.25 million without incurring estate tax, which is 40%. So there are also much more complex strategies will involve to fully leverage that estate tax exemption so you can transfer as much of the business value to the next generation for the minimum tax payments due. And then beyond all that, whenever you're dealing with family transfers, there are valuation issues, and you always need proper appraisals and things of that nature. And those would be the basic overview of some of the strategies we would use for business succession planning.
Thank you, Peter. I think you made a great point, too, about the ability to create non-voting common stock. A lot of times the transferring generation may have these mechanics in the works years before they actually finally decide to move control of the business operations to the next generation. And so they can create an amount of voting stock that perhaps has a minimal amount of equity value in the company, but has all of the voting control and be able to manage the process. Thank you for those insights. Okay, moving on, since our topics take us from many different directions, now moving into a completely different topic, an overview of the trademark filing process. And this I'll just very briefly go over, but I wanted to talk about it a little bit just because sometimes it's easy to take for granted the trademark filing process. Just at a basic level, trademark filing helps protect a company's value by protecting the naming rights of a product or the company itself. And the process of gaining a trademark is fairly straightforward. Normally what will happen is there will be an initial recognition of needing a trademark. Hopefully that's at the earliest stage possible. Then a knockout search is performed to determine whether there is danger of somebody else already having trademark protection on a name that's too close or identical with the one that's being sought. In order to just determine whether it's likely that a trademark application would be successful, then actually going through the application, and there can be the process for going through the application can take 12 to 18 months in some cases. Normally it's at least 6 months. But the trademark office is going to need to review the application and then may have questions. There may be responses that are needed. And then hopefully at the end of the process there's a successful receipt of a trademark which will provide protection for the company's use of the name going forward. In situations to be careful about are if a business is up and running and if they do not have trademark protection and it comes to their attention that they should, and there are two risks. One is if they do nothing, that another entity will come out of the woodwork and ask them to cease and desist using their name, and they may be able to successfully force the company to change its name through legal processes, or even though there's no necessary contact from another party, going through the trademark search and realizing that it's not protectable. And in those cases, then decisions may have to be made about moving forward or possibly changing the name of the company in the least disruptive manner in order to comply with the laws. So the best medicine for, or the best policy for ensuring that trademark filing protection is gained is just to get to it early on in the process, where if there is a conflict, changing the name at that stage may not be detrimental to the company. Okay, another topic entirely, managing bank negotiations in mergers and acquisition transactions. The economy is improving overall, and so what I'm seeing out there is companies that are gaining stronger balance sheets, which is a very good sign. However, there has been a difficult period of years that a lot of businesses have come through, and in some cases, there may be sales of a business or a division of a business that involve very important aspects of managing a bank relationship as part of the transaction. And again, keeping the topic at a fairly high level, probably the most important thing is just keeping in mind going into a transaction the importance of the bank's relationship and interests in entering into the transaction. If a company is selling its assets or it's a division portion of its assets, the bank consent is going to be needed because the company is selling essentially what acts as collateral for the bank. So the bank may need to provide a collateral release, and the bank is going to have a definite interest and a very reasonable interest in understanding what is being proposed. And this is especially sensitive if the company does have a balance sheet that causes the bank to be needing to manage its risk. In some cases, a sale of a division, say for example, of a business may make perfect sense for the bank, but the proceeds of that sale may be entirely going back to the bank, perhaps less fees to accommodate the transaction. But it may be that the bank is going to have a legal ability to force the use of proceeds to go to paying down bank debt because it is a disposition of collateral, and it has the ability to prevent the transaction from going forward without its consent. So on the other hand, there may be situations where the balance sheet is strong enough where perhaps a portion of the proceeds are used to pay down debt, but the remaining collateral or the remaining vibrancy of the business, the cash flow, is sufficient to justify the banking relationship forward, and so it may not be as much of an issue, or it may be a time to reanalyze the banking relationship and possibly restructure the loan with the bank in order to tailor the needs of the company going forward after the sale of the business or division. The main thing I wanted to focus on is just the importance of clear and timely communication. Businesses should just be aware that banks have processes, and they're going to be needing to have good upfront communication with the bank to make sure that the bank is on board with what's going to happen. Avoiding surprises or last-minute changes, for example, in transaction structures. Sometimes the pace of it fairly quickly, and during the course of a transaction, parties may realize that they can obtain some benefits by slightly altering the transaction structure. Well, they need to be aware that within their bank, there may be processes that need to be followed in order to approve a change to the transaction structure, even if it seems to make sense from a business perspective. So having a good relationship with bankers and having good, timely communication is going to be critically important in facilitating the flow of a transaction, which will help to preserve company value, obviously, by bringing new funds into the company or by significantly enhancing the company's balance sheet. Next topic is, and this is one of two topics that is in the business blog from this year that really are reflections on books. And what I like to do sometimes is read a book and then consider the principles that it has. Sometimes it's nice to take a look at a topic that really has nothing to do with your day-to-day business and apply those principles and kind of gain some perspective on the issue. And one of the two books that I blogged about this year was Eliyahu Goldratt's book, The Goal. And this is a bit of an older book. It came out in the I believe, 80s. And this book is of particular relevance to manufacturing companies. The book was considered a classic book regarding productivity and efficiency, and it enunciated a theory of constraints for managing the flow of product through businesses, primarily in a manufacturing setting. But I think the principles apply to settings beyond manufacturing. One of the things that struck me about the book that I enjoyed was, and the book is structured as having a fictional story about a factory manager who's trying to improve the efficiency and productivity of his factory, and he has a whole series of processes that the materials flow through before they're finished and are ready to ship. And he's kind of reacting to problems every day. Everything is just kind of reacting to the latest need to expedite a product, and something's stuck at this stage, and this customer needs that. So he's really reactive. Through the course of the book, the manager touches base with one of his old friends who was a physicist who has become a process consultant, which is exactly what Eliyahu Goldratt is. So it's barely fictional, I guess. And the focus that the consultant brings to the table is an overall focus on every activity of the company advancing the company's overall goal, rather than having specific measurements that are applicable in different scenarios that may actually not advance the overall goal of the company. So the theory of constraints that's presented, an example of this would be if there is a process within the flow of the work in process that is essentially a bottleneck, dedicating resources to other elements in the process, which may be automated or non-automated, can actually restrict the overall efficiency of the flow of product. So, for example, if a machine is a bottleneck machine and it has a setup time, if a company has a crew that sets up the machine and then goes off to work on other machines while the process continues on an automated basis, and then when the process is complete, comes back from what they were doing and works on the new setup, it may actually be more efficient overall for employees to have some downtime sitting at the bottleneck machine, not working, so that the moment that the bottleneck machine's process is finished, they can begin that setup, rather than have those workers go work on another element of the process, and then when the bottleneck machine's process is completed, it may take them a few minutes to finish their other tasks, get back over, and it may seem intuitively that those employees are being unproductive if they're just sitting there by the bottleneck machine, but on an overall basis, their productivity may actually be increasing. The book discusses statistical fluctuations and dependent events, and it uses an interesting way of getting some of these concepts that actually are rooted in physics and applying them to a manufacturing setting. He uses an example in the book of a troop of Boy Scouts that are walking in a line, and they're trying to get to a destination. And maybe there are 20 Boy Scouts, and they all have different speeds, and they're all carrying packs with their lunches and everything. And there may be one Boy Scout who's a little bit slower than the rest, and that Boy Scout may be in the middle of the line. So some of the Boy Scouts may reach their destination very quickly, but really the process isn't complete until the slowest Boy Scout reaches the destination. So in the book, the manager experiments with some things, for example, loading up some of the faster Boy Scouts with more heavy packs in order to even out and moderate the speed of the entire troop, and then lighten the packs of some of the slower Boy Scouts so that the overall group improves their process time and reaches their destination more quickly. So it's a very entertaining way to try to discuss business process issues. The thing that I also took from the book was that it really focused on solving problems across disciplines. And getting back to the thought behind this webinar, hopefully it challenges us to be able to take random, very different types of material and really focus on the ultimate principle, which is, in this case, adding value to protecting and adding value to companies. So regardless of the application, keeping an eye on the ultimate goal is the critical component. Next topic is underfunded benefit plan issues in M&A transactions, and I'm joined by Greg Storm of Reinhart for his insights on this topic. Greg is part of our employee benefits group. And just to sort of set this up, there are complicated rules that can come into play when benefit plans are underfunded, and things have the likelihood of seeing an underfunded plan, thankfully, is starting to lessen. But there can still be situations where benefit plans are underfunded, and two basic topics or two basic categories of these types of plans involve multi-employer benefit plans and then single-employer benefit plans. And Greg, what are some of the issues that would come up in the two different types of plans, the multi-employer and the single benefit plans?
Yeah, thanks, Dan. And I think maybe we should even back up one step further and emphasize that I think today, at least in particular, when we talk about underfunding and we talk about some of the concerns and issues, we're really talking about potential pension plan liability. Health plans have obviously been a lot in the news with the health care reform law and all of the difficulties with the rollout of the exchanges. 401k plans always seem to be in the news because they're so dependent on the stock market and everybody looking at their account balances. But I think really the area where you can have hidden liabilities in the M&A world is with your pension plans, to the extent that employers still those plans. And again, just a quick reminder on what the differences are between a pension versus an account-based retirement plan. Your account-based 401k or profit-sharing plans, the employer contributes and or the employee contributes to the plan. The amounts go into the accounts, and then they're held by the plan. There's no additional liability for the employer. In the pension context, the nature of the benefit is that it's a stream of payments paid to the individuals, the eligible employees, after their retirement, and the employer is funding those benefits over time based on actuarial projections. Because the employer is funding the benefit over time, pension plans may at various times, and in a lot of cases over the last decade or so, have been underfunded. We still have a fair number of underfunded pension plans at this point. I think Dan had referenced that, or at least hinted that some of the underfunding is starting to go away as plans continue the 2008 stock market drop. But frankly, there's still a significant amount of underfunding that's sitting out there, and that's a liability that's sitting with plans and with employers as they move into an M&A context. Dan also mentioned the multi-employer plan world versus the single employer world. A multi-employer plan is a plan that is available for the benefit of union members, and that type of plan is jointly managed by representatives of both the union and the employer, or a variety of employers within the same industry. The collective bargaining agreement will typically provide for a contribution either on an hourly, weekly, monthly basis to the plan. And generally speaking, from the employer's perspective, if you have union employees and you send a certain amount in on a regular basis to a plan and you have no other oversight or management or administration, you're probably contributing to a multi-employer plan. Multi-employer plans, and Dan and I have run into this together, have potential exposure related to withdrawal liability. Withdrawal liability in its simplest sense basically says that if an employer ceases to contribute to an underfunded multi-employer pension plan, then the plan can come back against the employer and impose withdrawal liability on that employer. The idea is that the plan is trying to capture from the employer's portion of whatever underfunding might exist related to the pension plan. The calculation itself is complex and goes beyond what we're discussing today. I think it's safe to say that the dollar amount, depending on the extent of the underfunding in the multi-employer pension plan, can be significant and can be surprising when compared to what might be a relatively small number of employees. I think we've seen some situations where employers have millions of dollars of withdrawal liability exposure, and they may only have 5 to 10 employees on whose behalf they've been contributing to the multi-employer plan. The trigger, as we said, is when the employer stops contributing to the multi-employer plan. It can be a partial reduction or a partial withdrawal from the plan or a complete cessation of those contributions. And naturally, this potential issue arises when an employer is looking to sell the business. If you're looking at a stock sale, it won't necessarily trigger withdrawal liability per se, because the CBA, the collective bargaining agreement, may just transfer along with the sale and the stock. But in all likelihood, in an asset sale context, we might be looking at a withdrawal liability issue. We've got a bullet point here on exceptions, and I think this is one area worth noting and at least keeping in mind. Dan and I have some experience here. There is a construction industry exception to withdrawal liability. If an employer is in the building or construction industry and ceases to have the obligation to contribute to a multi-employer plan, and then correspondingly ceases to perform work in that industry and in that jurisdiction for a period of at least 5 years, no withdrawal liability will be assessed against the employer. I think it's the recognition from a policy perspective that employers that are in that industry, the construction building industry, that is subject to wide fluctuations in terms of workflow, maybe should be the recipients of a little bit of a break on the withdrawal liability rules. We also have potential concerns with single employer pension plans. As opposed to the multi-employer world, this is where the corporate or single employer sponsors its own pension plan. Everything is kept within house or utilized through third-party administrators, but the employer has that oversight responsibility on the pension plan. Potentially, you could have some unexpected liabilities that arise in the M&A context from different funding calculations. So when you're looking at single employer plans, you need to review funding status of that pension plan on both an actuarial basis and on a termination basis to make sure that you properly assess what the liability is that's involved in the sale. From an actuarial basis, what do we really mean? I guess the quick, easy description of it is it's funding over a number of years, typically 25 to 30 years. And on an actuarial basis, you might look at the assets that are held by the pension plan and say those assets support a statement that based on looking forward to steady contributions and steady growth of assets over the next 25 to 30 years, the plan may be 100% funded. However, if we were going to terminate the plan today, would the plan be fully funded on a termination basis? Basically, could the employer terminate the plan now and pay out lump sum amounts to all the employees, or use lump sums to purchase annuities on behalf of all the employees to represent the pension amounts that had accrued and been earned by all of their employees? That present value calculation requires a plan to have more assets, and the result could be that the plan might be funded on an actuarial basis but underfunded on a termination basis. I ran into that scenario within the last couple of years working on a transaction where we were representing the buyer, and the seller thought that they had a robustly funded pension plan. They said it was actually overfunded, and when we looked at the termination funding basis, the plan was actually underfunded. The result in negotiations was a purchase price adjustment of approximately $1 million for our. So that's at least an overview of some of the issues that you can run into on underfunding of pension plans in the M&A context.
That's great. As Greg mentioned there, that we had come up on a session where Greg was able to identify an exception that was very helpful in the contracting industry. So these rules are very detailed, and they're exceptions to exceptions. So we're available. He's also an expert in the Affordable Care Act area. Well, thanks, Greg. So moving to the next topic, completely different topic, shareholder agreement basics. And I'm just going to summarize this quickly because this ties into some of this, leads into some of the topics that Peter and I were talking about in the succession planning example. But shareholder agreements are relevant to helping to protect and grow company value even far beyond the succession planning whether those shareholders are family members or co-founders that are unrelated, or even preferred investors, et cetera. Depending on the type of the shareholder agreement is really going to govern the relationship between the shareholders and the company. Depending on the type of relationship that the shareholders have to each other, the agreement is some of the common features of a shareholder agreement. Transfer restrictions. One common example would be the company may be an S corporation for tax purposes. There may be a need to restrict transfers to an ineligible S corporation shareholder, which would cause the company to lose it. Or just general transfer restrictions that are subject to rights of first refusal. Actually, another overall transfer restriction may be restricting transfer of stock to a competitor of the company. It only makes sense for small share of stock in the company to a competitor, where the competitor may be interested in gaining information that it shouldn't really have. So that would protect company value by restricting transfer to a competitor. Oftentimes, while there's a general restriction, that restriction can be overcome through a right of first or second refusal, which means that if some shareholder does find the opportunity to sell their holding in the company stock, but it's a minority position, the company or the other shareholders may have a second right of refusal and have the opportunity to purchase the shares that were intended to be sold at the price. Oftentimes in practice, this right of first and second refusal practice restricts the right to transfer on a practical basis, because any potential buyer, if it's completely unrelated to the company, is not going to want to go through the due diligence process of investigating the company's value stock if that stock is subject to a right of first or second refusal. However, if there are refusal may be necessary and relevant because that employee may have information about the company. Transfers to facility estate planning are often allowed. As Peter mentioned before, tax can be minimized. Proactive estate planning, and oftentimes transfers within a family. Mentioned before already, transfers to ineligible shareholders. That can be an important thing to remember and have in place for an S corporation. Oftentimes, the question of what happens in the event of a death or disability of a shareholder is governed by shareholder agreement. Multiple goals here. It could be that there's a goal to actually provide liquidity for the estate of a shareholder member. So on death or disability, perhaps the company is obligated to buy the shares of that shareholder in order to provide liquidity for the family. It could go the other way. It could be that the company has an option to acquire on the death or disability of a shareholder in order to ensure that outside of the family or outside of the option if the cash flow of the company is an issue expected to be an issue. Oftentimes, purchases in the event of the death of a shareholder will be funded through shareholder health life insurance, and we're going to talk about that in a minute as well. Other events that can give rise to company sales, employment termination. That employment termination could be with cause, without cause, after retirement. Sometimes the terms of the sale will vary depending on the type of employment termination. Bankruptcy and solvency. What happens if a shareholder is about to have their stock recovered by a creditor and the company does not wish to have the creditor become a shareholder of the company? Oftentimes, the shareholder agreement will provide non-competition and non-solicitation provisions. This will prevent the shareholders from obviously competing or providing confidential information or soliciting employees to a competitor after the time of being a shareholder and during the time of being a shareholder. Come along provisions are typically for proposed sales of a majority of stock of a company. If a majority member is going to sell stock of a company, oftentimes in order to really make the sale viable, they're going to need to have the ability to cause the buyer to be allowed to acquire 100% of the stock of the company. So the bring along is going to allow a majority shareholder to have a market for their shares by allowing them to force minority shareholders to sell their stock as well to the buyer. A come along provision is the flip side of that and typically protects the minority. So if a majority is about to sell their stock and for some reason the buyer is content having a majority position but not a 100% ownership position, this come along provision gives the minority shareholders a right to require the majority seller to negotiate for the buyer to acquire their shares as well. So they get a liquidity event as well. So those are some of the key provisions of a shareholder agreement. Obviously, every situation is unique and must be tailored to govern the goals of the family, the company, or the founding and investing members as appropriate. I'm going to touch very briefly on common issues relating to shareholder life insurance policies. Peter touched on this in the succession planning portion of the presentation. Just a few quick words on this. Question may come up as to whether shareholder life insurance policies should be held at the shareholder level or the company level. And there are advantages to having the insurance held at the shareholder level. For example, tax advantages. If somebody is deceased and life come to the shareholder who survives, they can use those proceeds to acquire stock from the deceased shareholder's estate and receive a tax basis credit in the shares that they've purchased. Whereas if the company holds insurance policy and receives the funds and then redeems the stock from the deceased estate, those shares are added to the company's capital and are eliminated without the shareholder, without the tax basis increase. However, there are also complexities that come along with holding life insurance at the shareholder level that many families or unrelated shareholders have to deal with. If there are more than two shareholders, it becomes very complicated if you have to uncross policies after the death of one shareholder, and then proceeds are going to multiple other shareholders, and then the policy that was held on the life of the survivors from the deceased shareholder now has to be uncrossed. Also, there can be a practical issue of what happens if the shareholders that receive funds and they're supposed to use those funds to purchase shares from an estate of a deceased shareholder, but they fail to do so. Oftentimes, a life insurance trust, an insurance life insurance trust, will be useful. And Peter, you mentioned I believe you called it an ILIT. Is that a topic here?
Yeah, this is an irrevocable life insurance trust, and they have a number of advantages to the situation, but you just want to be careful that they're properly structured so that they actually fulfill the goals of people creating the trust and the business owners.
Right. So please let me know if you'd like more information on some of the advantages and disadvantages of the shareholder life insurance policy holding structures. In some cases, the complexity of holding the insurance outside of the company, which may produce advantages, but it may be offset by the complexity of some of the issues that are involved. Sometimes a corporation will simply hold the life insurance and then use the proceeds to redeem out a deceased shareholder in that case, or obviously hold key man insurance to protect company value in the event of the death of a critical shareholder employee. Next issue is our second book review. The book is called Antifragile, and it was written by Nassim Taleb. And if you haven't heard of Antifragile, perhaps you've heard of his previous book, The Black Swan, which was also very interesting. Nassim Taleb is an economist who has a very detailed technical way of writing. So reading his book, if you're an economist, that's probably reading it word for word is probably the way to go. In general, though, he does come up with some very interesting ideas, and I found Antifragile to be thought-provoking. One of the most interesting discussions in the book is the title. Antifragile apparently is not truly a word, or he invented the word. And what he wanted to do is he wanted to think about, after his book, The Black Swan, he wanted to think about what is the opposite of fragile. And his example was thinking of a box full of glass objects that if you drop it, all the glass would break. That would be obviously a fragile situation. So he thought, well, what's the opposite of fragile? And he said the first thought that came to his mind was, well, what if you had rocks inside of the box? So you drop the box of rocks and nothing breaks. But he said he thought that really doesn't capture the opposite of fragile because the opposite of fragile would be something where if you dropped the box, the contents of the box would actually somehow become stronger, and the rocks would be resistant to the impact of a sudden force. But he said, what about the ability to actually thrive and grow from adverse effects or adverse experiences? And he's talking about this in the context both of individual businesses, but also of an economic order as a whole, a social economic order as a whole. So for him, anti-fragile was a term he needed to invent in order to really get across what he was thinking of. And he's thinking of, in nature, he gives some examples of anti-fragile events. He gives the examples of bone density and exposure to toxins. So he says if human bones are not exposed to levels of impact on a consistent basis, they will become weak. But if they are exposed to levels of impact that are not so destructive as to break the bone, which obviously as a one-time event is not a healthy event for the bone. But if they're exposed to manageable but continued and increasingly high levels of impact, they grow stronger over time. And then exposure to toxins is another example he gives. So your body can build up a resistance to a toxin through exposure to limited adverse toxins over time. So he wanted to think about the impact on businesses, and I think what his point is that if a business operates in a protected state, where it's not really exposed to adverse impacts, adverse problems, things that are potentially life-threatening to the business, then that business is not going to progress. Innovation is not going to thrive. Every business and economic system needs to be exposed to difficult, adverse events, and it needs to continue to innovate. It needs to develop ways of solving problems and overcoming issues and become stronger over time, much like the bone density example and the body toxin example. So I thought it was a good reminder of, especially as a lot of businesses have come through a 5-year period where there have been a lot of adverse experiences, that businesses that have survived that are now oftentimes stronger. And I've talked to company CEOs, owners, and CFOs where they're really highlighting having come through a difficult experience, and the business, its employee base, its culture, its character have really improved and become strengthened through that process. So again, adding value to a company can come in strange ways, even in less desirable events. Okay, we're coming close to nearing the end of the webinar, and I want to be very respectful of everybody's time. There are 2 topics left, and I'm probably going to talk about them both together. They're both related topics, talking about more the end of the stream of a company's lifetime, an exit event without succession planning within a family or a related employee base, but to a buyer. And just talk about the basics of letter of intents and asset sale agreements. The letter of intent is typically going to be a non-binding type of agreement that provides a 60 to 90-day time period for buyers and sellers to continue to investigate the idea of advancing toward a transaction, a sale transaction. And typically the letter of intent is going to provide a basic transaction structure, although sometimes they leave that open and the parties can continue to consider that as the discussions move forward. Oftentimes, the idea behind the letter of intent is to kind of hit the high points of what the deal is going to look like without having too much time and energy spent at that point, because you want to have that letter of intent before doing additional due diligence, and some of the additional work that the buyer is going to do in looking at the company is going to fill in some of the gaps. So the form and timing of consideration, that may be cash payments, obviously, but it may also take the form of stock of an acquiring entity, or timing of consideration could be obviously cash paid at closing, but it also could be cash paid on a deferred basis, and it could be released through escrow provisions. Escrows are going to generally protect a buyer from unanticipated events that are discovered after the transaction, related to representations that were found to be where there was value found to be less than then described in the representation of warranties after the transaction. So the escrows are there to protect the buyer, but they may be released once the contingencies are satisfied after the closing. Earnouts, there's a bit of a similarity in earnouts to the topic that we talked about at the very start of the webinar, coming full circle to when private investments were under our examination, where there was a discrepancy about value of the company from a founding group and a proposed investor. With an earnout, it's essentially the same issue on the backside of the transaction or the life of the business. The sellers may believe that the value is one thing, and the buyers may be concerned that it's another. And an earnout is a way to try to bridge that gap, where post-transaction performance is going to help to track whether additional payments will be made, and if performance after the transaction is sufficient to satisfy goals that are consistent with the value position that the sellers had, then they'll receive additional payments to reflect the value that was sold as a result of that transaction. Whereas if the projections are not met, well, then it's more consistent with maybe what the buyer's position was, and the earnouts would not be paid. So it prevents the buyer from paying additional funds for a company whose value was not as high as the sellers thought. Employment or consulting arrangements are often critical. Obviously, in a transaction where the buyer is considering needing participation from existing employees or owners after the transaction, so the letter of intent may outline the basic terms of what employment and consulting arrangements are going to be needed, and it may have conditions on certain key employees staying with the company after the transaction. And then there will typically be confidentiality provisions to protect the confidentiality of the transaction while the letter of intent is in place. If the parties are able to come to terms during the time period for the letter of intent, then they would typically enter into a purchase agreement. It could be an asset sale purchase agreement or a stock sale purchase agreement, or it could also be a merger, or there are various types of mergers as well: forward mergers, reverse triangular mergers, forward triangular mergers. It's beyond the scope of what we're talking about here to go into all of the merger transaction formats, but take, for example, a sample sale purchase agreement for an asset sale. The agreement would typically contain provisions that discuss and clarify the nature and identity of the assets being purchased. It will describe any excluded assets that are being retained by the seller, specifically describe any liabilities that are being assumed or retained, describe purchase price and closing mechanics. I mentioned representations and warranties that would be made by the seller, post-closing covenants, including things relating to, for example, taxes, employee benefits, environmental compliance, etc. Indemnification provisions are provisions that would protect the buyer against representations and warranties made by the sellers, for example, and they can go both ways. Baskets and caps are limits on how much may have to be paid out by sellers for violating representations and warranties, and baskets could segment types of claims within a type of basket that has to reach a certain level before the indemnification provisions apply. And then materiality and knowledge qualifiers is a concept that agreements typically use to describe whether the sellers had specific knowledge of a representation and warranty that, if violated, would require them to be liable, and also whether a particular item is material in scope. That concludes our walk through 12 ideas for enhancing and protecting and growing company value. And at this point in time, I'd like to see if there are any questions that have come in. Looks like at this point in time there are no questions, so please feel free to contact any of us after the presentation if you have further questions. But thank you very much for attending this webinar, and we're right on time, so we'll go ahead and end at the 1 hour mark. Again, please feel free to contact me if you have any questions about any of the topics that were presented.